Internal Revenue Service IRS tax news. Taxpayers may receive a refund for taxes paid on 2020 unemployment compensation. COVID tax tip 2021-87, June 17, 2021. The IRS is reviewing tax returns filed before the American Rescue Plan of 2021 became law in March to determine the correct taxable amount of unemployment compensation and tax. Let me see if I can recap this because this is kind of a complicated item and I know it's been of concern to many people. So normally unemployment compensation before 2020, generally it was a taxable thing, meaning that once you received unemployment compensation for the year, you typically get a 1099 from the state indicating that you have to include it in income. And that's usually bad for taxes because it is an income tax. So if we have to include it in income, then we're typically going to have to pay taxes on it. Now, they passed a law in 2004, the year 2020, that basically much of that unemployment compensation would not have to be included in income, which is good, but they did it kind of late. Therefore, many people still included it in income, and now they have to deal with the consequences of that. Now, normally you would think that if you included something on the tax return that shouldn't have been there, then maybe you would think that you have to file an amended return in order to fix the problem. But the IRS, partially because I'm assuming this was kind of their fault that they entered it late, this change late, says that for most part, they're going to basically do the adjustment on their side and then give us the refund, and you shouldn't have to do an amended return unless you fall into basically a special condition or a special category. Now remember, when we're thinking about the unemployment, if you got, for example, $1,000 of unemployment compensation, it's still a little confusing because you would have got the 1099 still, which usually indicates that you'd have to include something possibly on the tax return. So that's still a little bit confusing. The tax software, if you have not yet filed, should help to kind of fix the problem at this point, hopefully, giving you an interview type of process to help you to determine what kind of things you have to include in income or not. But if you had included it in income before and you're looking for the IRS to make the adjustment, note that you wouldn't get the whole $1,000 back if that's what you included it in income, because what you would get is the change if you had not included that in taxable income. Meaning if you take the $1,000 out, then whatever your tax rate is going to be partially what you'd be paying taxes on. You would have paid taxes based on your tax rate. And there could also be a lot of other kind of complex type of issues, including the child tax credits, the earned income tax credit, other credits, other phase outs. And that's when it gets kind of complicated to figure out what the consequences will be. But generally, the bottom line is that the IRS is going to try to fix these for the most part on their end. You shouldn't have to file the tax returns to do so, and it's going to take them some time, it looks like, to basically process these things and then send out the refunds. So I would suggest on our end that you should at least possibly use the tax software if you have access to it, figure out what you think the refund which should be without actually filing an amended return so that you can double check what the IRS comes up with and see if you agree with it or if you fall into one of those rare categories where you actually do have to take some action on your side. So that's my general recap of it. So let's see what they have to say here. For eligible taxpayers, this could result in a refund, a reduced balance due, or no change to tax. IRS efforts to correct unemployment compensation overpayments will help most affected taxpayers avoid filing an amended return. So they're hopefully, again, this is not your fault or generally not people's fault for filing the taxes because they did this late. They're going to try to fix it on their end without having to file an amended return on your end. If you do file an amended return, you may actually confuse the IRS. And like I say, you don't want to confuse. You don't confuse the IRS because then they get confused and things just take longer. They just stop doing stuff if that happens mainly. So try not to confuse them. Some taxpayers will receive refunds, which will be issued periodically, and some will have the overpayment applied to taxes due or other debts. For some, there will be no charge. The American Rescue Plan Act of 2021 excluded up to $10,200 in unemployment compensation per taxpayer from taxable income paid in 2020. So that's how much was excluded. So $10,200 was the excluded. So once again, the American Rescue Plan of Act of 2021 excluded up to $10,200 in unemployment. So that means, once again, even if you had $10,200 that you included in income, which now they're saying should not be included in income, you would not expect a $10,200 refund. You'd be expecting whatever the tax consequences of adding $10,200 of income on the tax return would be, which would be in alignment with your tax rate, as well as, again, it could affect various other things, including these credits, which all got kind of adjusted during this time period. So it could have a significant impact on them. Tax software is helpful to kind of check that out and see what the impact actually is if you were to remove that income. So taxpayers should not have been taxed on up to $10,200 of unemployment compensation. This is not the amount of the refund taxpayers will receive. Other adjustments: the agency is also making corrections for the earned income tax credit, premium tax credit, and recovery rebate credit affected by the exclusion. So the exclusion, then, you'll note it's coming out of income, which, if there wasn't any other kind of confusing components in place, would be a fairly straightforward thing. But it could have an impact on the earned income tax credit, which is a very complex credit to actually calculate. Using software helps a lot. So they're going to try to make most of the corrections that would impact even those credits: the earned income tax credit, the premium tax credit, and the recovery rebate credit. So the IRS can adjust tax returns for those who are single with no children and who became eligible for the EITC, that's the earned income tax credit. The IRS also can adjust tax returns where the EITC, earned income tax credit, was claimed and qualifying children identified. Taxpayers who have qualifying children and became newly eligible for the earned income tax credit after the exclusion is calculated may have to file an amended return to claim any new benefits. So you've got this one kind of weird situation resulting in conjunction with the earned income tax credit, which is quite a complex credit, where the IRS might not be able to pick it up on their end, and you might have to actually file an amended tax return. So what you might want to do, because it can get kind of complex with these credits, and they might get, there's nothing to say that they won't get it wrong in any case, So you might want to actually calculate it on your side with the tax software, possibly removing the amount of the income from the tax software. If you filed with tax software, or possibly getting access to a software so you can do that, maybe it might make it easier if you have a complex return, and the earned income tax credit does make things substantially more complex. Then you can take that out and see what you think they should be doing, and then you can double check that to the adjustments that they make and make your determination as to whether you want to take action from that point based on whether you think they're correct or not. But the one kind of place where they're claiming that, once again, they might not have, they're claiming they might not be able to do the calculation correct is, once again, taxpayers who have qualifying children and become newly eligible for the earned income tax credit. How would you know if you became if you fall into this category? There's pretty much no way you would know unless you actually did the change on your end, right? Because this credit would be something that you would be known by the fact that you'd be filing a tax return, and most people would have to use tax software, or it'd be a lot easier to help them know whether or not they're newly eligible for the earned income tax credit. So again, taxpayers who have qualifying children and become newly eligible for the earned income tax credit after the exclusion is calculated may have to file an amended return to claim any new benefits. If the IRS adjusts someone's tax return, the taxpayer will receive a letter within about 30 days explaining what kind of adjustment was made and the amount of the adjustment. Types of adjustments include a refund, payment of IRS debt, or payment offset for other authorized debts. Offsets include past due federal tax, state income tax, state unemployment compensation debts, child support, spousal support, or certain federal non-tax debts such as student loans. Taxpayers should keep any IRS notices for their records and review their tax return after receiving any IRS notices. More information can be found at the links below, including the tax treatment of unemployment compensation and unemployment compensation exclusion FAQs, frequently asked questions. There's links to those items here, and there'll be a link to this in the description.